Can I actually get a 40-year DSCR loan, and what's the real catch? Hi everyone, and welcome back to my channel where we dive into the world of real estate investing. Today, we're going to talk about a type of loan that's gained popularity among investors, the 40-year DSCR loan. We'll be uncovering some of the often overlooked risks associated with this loan, so if you're considering this option, you won't want to miss this. The idea of a 40-year DSCR loan sounds pretty appealing, especially for real estate investors looking to maximize their cash flow. With a longer loan term, your monthly payments are lower, which can free up more money for other investments or simply for managing your properties. But here's the thing, what seems like a blessing can sometimes be a curse in disguise. The allure of lower payments and higher cash flow is undeniable, but it's crucial to look beyond the surface. These loans might just lead you into a financial trap that's hard to escape. And that's exactly what we want to explore today. When you take out a 40-year DSCR loan, you're essentially stretching out your mortgage payments over a very long period. This means you're building equity in your property much slower than you would with a shorter-term loan. And let's not forget about the total interest paid over 40 years, it's significantly higher. This could be a major drawback for investors who plan to sell the property or refinance it in the future. You're essentially betting that the property's value will increase enough to offset the higher interest. Another risk involved with these long-term loans is the potential for negative amortization. If your loan is structured in a way that allows for this, you could end up owing more on the loan than your property is worth. And then there's the impact of market fluctuations over 40 years. It's unpredictable and can be harsh. Economic downturns, changes in interest rates, and local market conditions can all affect your investment. To put this into perspective, let's consider a hypothetical scenario. Imagine two investors, both buying a rental property worth $300,000. One takes out a 20-year DSCR loan, and the other opts for a 40-year DSCR loan. Both loans have the same interest rate and terms, except for the duration. After 10 years, the investor with the 20-year loan has built a significant amount of equity and has a much lower loan balance. Meanwhile, the investor with the 40-year loan has barely made a dent in the principal and has paid a lot more in interest. This example illustrates how a 40-year DSCR loan could lead to a less favorable outcome. The financial implications here are substantial. Not only do you have less equity in your property, but you're also paying more in interest over the life of the loan. This could severely limit your options if you need to sell or refinance. In conclusion, while a 40-year DSCR loan might seem like an attractive option for maximizing cash flow, it's essential to understand the long-term risks. Slower equity buildup, higher total interest paid, and potential for negative amortization are just a few of the pitfalls. Before choosing this type of loan, make sure you've crunched the numbers and considered the potential downsides. If you've had any experience with DSCR loans, I'd love to hear about it in the comments below. Have you encountered any unexpected challenges or benefits? Share your stories, and let's get the conversation started. And if you're new here, consider subscribing for more in-depth real estate investment analysis and tips. Thanks for watching.